HP is down almost 8% after earnings to $28.71 a share. Warren Buffett loves this stock. They bought 11% of it with Berkshire Hathaway. It was at $35 a share. So with the share price at 28, is this the right time to buy? We're going to be going through the latest earnings, breaking those numbers down, comparing to the previous years, and then taking this to my discounted free cash flow model and my Buffett-Graham intrinsic value model to see if it is a buy or a sell. It'd be interesting to see what the Buffett-Graham intrinsic value model gives this stock with Buffett buying at 35. So just talking about the stock, you can see that it's $28 a share. If we go to the last year, it's actually been relatively flat, only down just under 2%. Even on the year to date, it's, well, that's even a lot better because a lot worse because it's down 24%. The market, if we compare it to a similar time, the market is down 17%, whereas HP is down 25%. But if we go over the last year, you can see that it's actually a lot closer. Over the last 5 years, HP has not been beating the market 48 to 59%, but this has grown pretty dramatically since the bottoms of the 2020 pandemic. And Buffett bought a few months ago, and the stock price went up massively and has now dropped back down way below what he bought it at. So let's have a quick look at the financial statements here. We have the 3 months ended in 22, which is their most recent numbers. The 3 months ended in April 22, which was the previous quarter. And then this time year ago, July 21. Firstly, looking at the revenue. Current revenue is 14.6 billion, lower than it was the previous quarter of 16.5 and lower than it was this time last year at 15.2. So this is why part of the reason why the stock has plummeted in today's trading. We want to look at the profit next. How do we get profit? Revenue minus all the costs and expenses plus everything else. And we can see the revenue is actually up 1.119 billion, up from $1 billion in the previous quarter and beats this time last year in 1.1. So HP have managed to able to generate a lot more profit from the revenue. As you can see here, cost of revenue is down from what it was in April 22 and also down from what it was this time last year. R&D is down as well, and general and admin is down quite a lot, almost down 300 million, which is excellent to see. Everything else is down massively as well. So that is why they've been able to generate more profit. Just quickly looking at earnings per share, you can see the earnings per share is up $1.09 compared to 95 cents and 94 cents. And we've got cash dividend selected per share at 50 cents. Just talking about the dividend, actually, this stock has a very nice dividend, 3.5%. So that is a very good dividend stock, very well paying. The average of the S&P is around about 2%, maybe a bit lower, and this is a lot higher. So if you're interested in dividends, this could be the stock for you. And next, we want to be looking at the shares outstanding. Are they buying back their shares or issuing more shares? And you can see here the number is decreasing and decreasing pretty rapidly. They had 1.185 billion and now that is down to 1.024. Why is this important? Well, because you own 1 share and there's 10 shares, you own 10% of the company, they buy back 5 shares, you would then own 20% of this company. And if we look as well, if we go at the stock price over the last year when they've been buying it at a relatively higher price. Yes, it has dropped off since then, but the stock has been pretty stable. So it's not like the stock has shot up. They've been buying back their shares at a sky high rate and then it's dropped down. It's been relatively flat over the last year, so not too bad. So they have been rewarding shareholders pretty well. And if we compare it to some companies that are similar, then Cisco down 24% on over the year, Intel down 40%. So this stock has been a lot more stable, big dividend payer, and Warren Buffett seems to like it as well. Next, we're going to look at the free cash flow. So to go over here, we have to scroll down to the cash flow statements and we get cash from operating activities, which is this line here, minus capital expenditures. And we can see the net cash from operating activities is about 400 million, down from 1 billion in the previous year. And the capex, didn't have any capex in 21 and is now 25. So we've got about 370 million in free cash flow for the quarter. If we just quickly go to my Yahoo Finance, these are the previous numbers. I do actually have the total numbers here. We've got the P ratio very low, 5. Market average is about 21. If we go to the S&P 500 P ratio, actually it's a lot lower now, down below 19. That's the lowest I've seen that in quite some time, 19.98. So, but once again, HP is a lot lower than that. Revenue, we can see the revenue has increased. It's 64.8 billion in the trailing 12 months. Profit, 6.3. Shares outstanding, as we saw before, 1.024. 1.24 billion, and the free cash flow 4.7. This has been a lot more steady. If we go to Yahoo Finance here, you can see this is the lowest cash flow. 21 was 5.8, we're down to 4.8 here, but beats the previous years. So overall, it is looking pretty good. Now, these are decreasing numbers, but the free cash flow ratio very, very low, 6.25. So I'm expecting that the discounted free cash flow model will absolutely love this stock. So let's get into it. Firstly, we're looking at the averages. We're increasing we've got the calculated free cash flows to a terminal value discounted to today, and this gives us a value here. So what does this give us for HP? I think it'll really like the stock. And as you can see, it absolutely loves it. $118 a share, maybe a touch on the high side. So let's see if we think these numbers are fair. First one I want to look at is the revenue growth rate. Based on the averages, it's about 1.9%. But if we look here in 22 and 23, they're actually expecting negative growth. So we'll just go with 1.6% for now, and then we'll put in the negative numbers. Net income to free cash flow, once again, this is higher because of 18 and 19, so we're going to drop this down to 2020's number. We'll meet in the middle, actually. We'll go at about 82%. And the net income margins, I think these are going to increase. So I think that's a fair estimate to say about 9.72%. And interesting enough, that puts us at pretty much the same price again, $115 a share. Now, if we were to do, let's see if we can do this, see if we can do some negative growth, puts it down to $111 a share. So overall, discounted free cash flow really likes this stock. Now, if this was to continue decreasing, let's say minus 3%, it would still be over $100 stock based on discounted free cash flow. Then we're going to look at the Buffett Graham intrinsic value. It takes earnings per share. Earnings per share based on the trailing 12 months is $5.47. Analysts, if we go to Yahoo Finance, this will give us the analyst growth. And over the next 5 years, they're expecting about 7.57%. We can actually see that it's up in the after hours, up almost 1% at $29 a share. So maybe people think this was a pretty big sell-off, unnecessary, and they want to get back in on the stock. Very interesting there. Let me just quickly go back. So as we said, 7.75, and the AAA bond yield is about 4.06%. What does that give us for a Buffett Graham intrinsic value? A fair value of $147 a share and a Graham price of $110, which is very, very close to the calculated stock price based on discounted free cash flow. So both of the models are saying it is a buy. I do think that is a little on the high side, but both models are in agreement. And if we look at the analysts, what are analysts saying? A lot more bearish on the stock. This time in 12 months could be anywhere from $25 to $36 and an average of 31. So all of the models are saying it's a buy, and the analysts are saying it's a buy. Right, guys, thanks for watching. Please give a like on the video if you enjoyed it. Subscribe if you're not already, and I'll catch you guys next time.